welcome to the Fund Finance series. I'm Michael Mbayi, Head of Banking and Finance of the Luxembourg law firm Praxio. The Fund Finance series, you know the formula. I invite leaders in industry and we discuss about a specific topic. The topic of the day is 2024 market perspective. And to discuss this topic, we have a great panel today. We have Aleksandra Cison, Director at HSBC Innovation in London. Hi, Aleksandra.
Hi, Michael. Thank you very much for having me here. Aleksandra Cison. I'm a director in the Strategic Fund Solutions team at HSBC Innovation Banking, based in London. We provide specialized fund banking and financing solutions to mid-market private equity and venture capital.
Thank you very much, Aleksandra. You have also Michael Hubbard, European GP Solution at Cadwalader in London. Hi, Mike.
Hey, Michael. Thanks for the intro. So as Michael suggested, I head the GP Solutions platform at Cadwalader. It's pretty ambiguous, but essentially what it is a quasi-debt advisory practice that sits alongside the legal practice. So we'll advise GPs across plethora of fund finance structures on both the commercial and the legal aspects on raising finance.
Thanks, Mike. We have also Sarah Lobbardi. Sarah Lobbardi is founder at Avardi Partners in London. Hi, Sarah.
Hi, Michael. Thank you for inviting me. So I'm Sarah Lobbardi. I've launched Avardi Partners nearly 6 years ago now. We are debt advisors specialized in the fund finance space. We work with fund managers in Europe and in the US to help them raise debt at the fund level, and we cover all asset classes.
Thank you, Sarah. We have also Don Metheven, Counsel at Freshfields in Hong Kong. Hi, Don.
Hi, Michael. Happy to be here today. So I'm a counsel in the Finance Capital Solutions team at Freshfields, based in Hong Kong. My practice covers a range of financing across Asia with a focus on fund finance. So that's acting for mainly lenders, but also across the fund structure on holdco and investment level financings covering PE, real estate, private credit and special sits lending.
Thank you, Don. And you have Corinne Musa, partner at Akin in New York. Hi, Corinne.
Hi, Michael. Thanks for having me. I'm a debt finance partner at the law firm of Akin. We've actually rebranded. We used to be Akin Gump. Now we're just Akin. My focus is primarily on fund finance from the borrower's perspective, sometimes from the alternative lender perspective. And I've worked on really all types of facilities for all types of funds, private equity, venture capital, credit, and hybrid funds. For the giant sponsor clients and the first-time fund clients. So just happy to be bringing that perspective to the table today.
Thank you, Corinne. And to the audience, do not hesitate to send your questions. There is a question button. So we'll take up questions relevant with the topic of today during the event. So to keep this interactive. So as a kickoff, Aleksandra, I would be curious if you can do a recap of the year 2023. In terms of activity and what was your perspective for this year?
Absolutely. Happy to make a start, Michael. I think if there's one thing we are all going to agree upon today is that 2023 was challenging. We went into the year with the global economy already grappling with unstable geopolitics, inflation, rising interest rates. We then saw not one, but a whole sequel of bank collapses, which understandably prompted concerns about the health of the wider financial markets. And then another conflict broke out, sending new geopolitical shocks around the globe. So, all of this created a rather high level of uncertainty in the economies around the globe. And economic uncertainty has to do with it that it leads to tightening in the financing markets, which then affects deal making, which last year would have already been affected by the gap in the valuation expectations because of the rising interest rates. And then the next thing that happens is exits dry up, which then results in slower fundraising because capital is not flowing back to the investors. So, it's been a little bit of a chain reaction, and we have seen a lot of it play out during the course of last year. Fundraising is obviously it's been a huge topic, and I'm sure we're going to talk a lot about it today. Even though we now know that private equity actually finished last year quite strongly, it's been a rather diverse picture across the sponsor spectrum. From where we sit, we have seen managers who've done exceptionally well navigating the difficult market, especially those established names with an excellent track record, but also those managers who pursue maybe some of those niche strategies with a very clear investment focus. They've done very well. And then at the same time, we've seen the other end of the spectrum, managers who frankly struggled, and in some cases being on the road for 18 months and still not reaching their targets. So, that's fundraising. But there is one topic that I did want to mention here, and I would be interested to hear what others think about it. It's the emphasis on relationship banking. And now, I wouldn't necessarily say it's a new thing. And I remember I gave a presentation exactly 12 months ago, and I already spoke about it then. But it does feel like this topic sort of came to the surface during 2023 in the increasingly uncertain world. So, banks have become more and more focused on lending to sponsors where they see potential to build a wider relationship, to to earn ancillary fees. And at the same time, from the GP's point of view, if you partner up with a lender who sees you as strategic, that means you will have access to the balance sheet when those accordions get exercised, when you ask for financing above or below the fund level, and also, to give you some room for negotiation around pricing and structuring. Last year, we saw substantial widening of spreads, especially in the mid-market space where we operate. And now, I will be very interested to see how this is going to develop this year. Towards the end of last year, we did see a handful of new entrants in the fund finance space, some of them sort of re-entering after a period of inactivity. So I'm going to risk saying that I suspect, some of those high-quality mid-market managers who are expected to do well on fundraising this year, I do think they will end up attracting high levels of competition, which may lead to narrowing of spreads. So I'm going to leave it at that to see what others think.
Thank you very much, Aleksandra, for your perspective. And Sarah, what can you add from your side?
Yeah, well, first I echo with everything Aleksandra said, so I won't repeat that part, but maybe I'll just give my perspective as we are an advisor of how we saw a change. I think in the past, we did all the products and we had quite a high volume of capital call facilities and NAV. But what we have seen is actually during 23 and even now 24 and our pipeline, we are mostly doing NAV financing. And that's most of the mandates we're getting. And I think, there are a few reasons for that. Obviously, we're not a lender, so we don't do kind of extensions and upsize necessarily. And fundraising has been really slow. Some managers are struggling to fundraise. Some of them are experiencing massive delays, which means we are seeing, and it's, you will speak to different countries and different people, they will tell you it really depends. But overall, the numbers speak for themselves. There is a slowdown, and that means, if people take longer to fundraise, there will be less capital call facilities to do. So we really saw that shift on our end. And today, we are doing only a handful of capital call facilities when we're doing a lot more NAVs. And I think also the increase on the NAV mandates we had is due to a few different things. I mean, over the years, we spoke a lot about, NAV for PE, which, I mean, it's not really a new topic anymore, far from it. But we have seen two asset classes that were not used to be as active in this kind of product become really active, which are real estate funds and infra funds, and notably credit infra. And to be honest, in the past, we were used to do a few infra funds for NAV financing. It didn't really fit their, requirements in terms of tenor and what they were trying to achieve. But I would say a big proportion of what we did in 23 has been real estate and infra. And that's true also in the US. So we are getting a lot of inbound from those managers saying, we want to put liquidity at the portfolio level. And, we are seeing an increased sophistication of those asset classes. So for us, it was a completely different year. We're doing nearly only NAV financing, more asset classes that were used to be a minority of deals for us are now becoming really predominant in terms of our flow. So I think that's the first thing we've noticed, and we think that will remain the case because a lot of big clients we're covering who are either doing credit or just infra are launching kind of those different strategies and so on for other managers. So that's the first big change we have seen on our end. The second thing that I think is worth mentioning is that we are working with more and more non-bank lenders. And I think in the past, when we did capital call facilities, it was mostly with banks, and that's still true. We will also work with NLC, but I would say it's still a bank-dominated market. When it comes to the NAV financing, interestingly enough, now we see names like Carlyle, Apollo, Ares who can come to NAV financing at lower price than they used to be, with big ticket size because they have third-party balance sheet. And that makes a big shift to the market. So we're looking at some deals now that they will have been 12 months ago fully, banks on it because it was cheap pricing and the type of risk that only banks would want to look at. And today we have big non-bank lenders doing those facilities, even at really low cost, So that has been also a very interesting trend, and we believe that will keep increasing because we are having conversations with a lot of non-bank lenders which are developing these new strategies with pension funds, insurers, balance sheet, and are able to kind of make a different offering on the NAV market. So that also has been a very interesting trend we have seen. I will add one thing and I will stop because I could speak literally for hours, but there are other people. The only thing last thing I will say is just we experienced the same thing that I'm sure Michael and the other people will also mention about pricing. It has been, hard to, on the cap side, really to do competitive deals. We've done, just now we closed a $1 billion facility below 2% margin, which is becoming rare these days. But it was a top manager that everyone wanted to do. Otherwise, we are seeing, pricing is not coming down. It is very selective to the point of Aleksandra. Lenders on the cap call want ancillary. They want, a broader relationship. It has to be the right story for them to do the transaction. That said, on the NAV market, it's not the case. It's very competitive. People are not necessarily as focused on the ancillary, notably when we're facing IBs or non-bank lenders. And there is a lot of kind of competition from lenders. So we're still managing to actually see a really competitive transaction. And I would definitely say pricing has not been up on that end. And I will stop here.
Thank you, Sarah. You have also a question from the audience, but I think that you take a lead already, Sarah. So in the leveraged finance space, private credit funds took a big market share, taking advantage of traditional bank withdrawing from the market, given the market situation. But I think that you covered already, Sarah, saying that indeed there is a alternative lender entering as well into the fund finance space. And then you are based in Hong Kong. I would be curious to also have your perspective for 2023 from Asia.
Yeah, so I mean, very similar sentiment to the others who've spoken already. Very challenging market. Maybe slightly more exaggerated in Asia. A lot of the geopolitical tension that people talk about is, necessarily focused on US-China relations. We've seen the China real estate market suffer, particularly towards the back end of 23, and that looks like it's continuing. So definitely a challenging time for GPs and for funds in terms of capital raising. And interestingly, that's, it's not necessarily resulted in a drying up of bank liquidity. Banks are still very much open. They're doing business, or that, they're certainly sort of keeping their lines open, keeping relationships close, and want to lend. But it's just a case of a function of a lower level of deal activity, being more specific about jurisdictions that can be invested in, LPs wanting to pivot away from certain jurisdictions, China, and look to other jurisdictions instead, which has meant that GPs have had to change their strategy. So, in terms of cap call facilities, certainly much lower activity. NAV and hybrids are still very nascent, I would say. So the market is quite far behind the US and certainly Europe in terms of what lenders can offer as a product. And I think the question is whether non-bank lenders can fill a vacuum there, or if the traditional lenders will start to sort of offer that more. So, there's, I suppose I would finish by saying that there's of course been winners and losers in Asia. So Southeast Asia, India have been attracting a lot more attention, and as a function of that, those funds focused on those geographics are humming away. Also Australia, South Korea, Japan. So it's not an entirely China story, and we're just seeing GPs adjust their strategy and sort of getting used to the environment they're operating in.
Thank you very much, Dan. And Corinne, from your side, from the US, what are your perspectives for 2023?
Yeah, I mean, these were all incredible summaries of sort of what was going on. I agree with everything that's been said in terms of, activity because of the regional banking crisis in the US. Obviously, those banks that were impacted were large providers of fund financing, capital call facilities, and the like. So following those failures and just addressing the in the weeds of what happens during an FDIC takeover and watching it play out of which banks are in play and actually picking up the pieces of the market, that has been just one sort of fascinating thing to watch in 2023. And then from the practical perspective, I think everyone else already gave very incredible summaries overall, but just the practical perspective for funds trying to figure out, where are their bank accounts? Like what bank are they using? Should they be diversifying their cash management? That was sort of another trend of just figuring out the implications of relating to those bank failures. And then flowing, from my perspective on, drafting how that all flowed through credit agreements has been interesting from my end. And then I agree in terms of the private credit expansion, and, that hasn't really covered the subline market from my perspective. It's been, private credit has been more focused on the NAV facilities, management fee lines, or GP lines, so not really covering capital call facilities, which have been fewer anyway in 2023. And that is one thing that's interesting about that is I think, the investment horizons for the private credit lenders aligns more with the investment period of the, private equity sponsors that they're lending to. So that's one sort of explanation of how that's played out. And then, as you were talking about, Aleksandra, about the relationships really coming to the surface, the banks, like the big banks, are the ones who have the relationships with all of these funds. And so I think private credit providers are trying to, they have capital and they're trying to line up with the relevant sponsors, but aren't necessarily the ones who are the natural connectors there. So, I'll let others weigh in.
Thank you, Corinne. And Mike, from your side, what can you add?
Not much. No, I think look, it's been challenging across asset classes and structures. I think focusing firstly on subscription finance, I think it could have been worse. You look at the record levels of dry powder and the associated capital call facilities that have to sit there to support that eventual deployment of capital. It's obviously consuming a lot, but then offsetting that was a pretty lackluster fundraising environment. So there weren't huge funds coming to market requiring additional liquidity. So whilst there was that liquidity crunch in 2023, I think it could have been a lot worse than what it was, and it's slightly masked by the lack of or the delayed fundraising. I think so Cadwalader as a firm, certainly in London, so I focus on European transactions, and Cadwalader London sees about 180 transactions a year. A big portion of that is subscription finance, and so we get an incredible amount of insight into some of the pricing trends, liquidity, etc. And it was interesting to see, and I won't be telling anybody anything that they weren't already aware of, was that illiquidity premium that came into the market in 2023. So average pricing for 22 on the transactions that we saw was around the 170 basis point mark on spreads. 2023 was 215. So there's quite a material widening of that. And I think Sarah touched on the point of the larger sponsors. There's definitely been a flight to safety. So a lot of the lenders in the market were definitely channeling capital to those larger sponsors. So if you're a large cap sponsor, you're probably still pricing inside that 200 basis point mark. But everybody else, unfortunately, is either just above or well above that 200 mark. Not seeing too many price over 300. Very conscious that the US market is seeing significantly higher pricing than Europe. And I think that was part of the challenge, actually, with certainly the banks or lenders that straddle both sides of the pond that have one balance sheet, is that a lot of the resource from Europe was being channeled into the US because capital committees were sitting there looking at exactly the same risk profile in the US and exactly the same risk profile in Europe, and thinking they can get a 30-40 bit premium for the same risk profile in the US. So a lot of capital was channeled that way. I think 2023, and I won't touch on the outlook yet because I'll be jumping ahead a bit, but 2023, I think lenders only really just started to come to terms with the possible implications of Basel IV. And I think this year we'll see a lot more of that, and we can touch on those implications. And I'm sure Aleksandra is be very close to that as a lender, as to what that means from a lending perspective, but that's going to have massive ramifications. I think on the NAV side of the financing, there's not a huge amount to say beyond what's already said. In all honesty, there was definitely an uptick. We saw a significant number of particularly primary buyout funds looking to access the NAV market. I think that the NAV market is probably where subscription finance was 10, 15 years ago, in that there's a lot of skepticism from LPs, and I don't think the broadsheets are particularly helpful in that regard. And Cadwalader spent a lot of time last year trying to debunk some of the misplaced or misconceptions in relation to NAV. I think there was the perception that a lot of these NAV financings were in place to accelerate distributions as a DPI play, where the vast majority of transactions that we worked on and that we saw was anything but. There was optionality to make distributions, but the primary purpose of putting that leverage in the fund was to focus on bolt-on, build-out, follow-on investments, rather than to make those distributions. So I think there was, we were certainly aware of and worked on a number of NAV transactions that GPs were fully consulting with their LPs on, and I think there was some nervousness. So a couple of those transactions have definitely been delayed for obvious reasons, just while they take that time to get their LPs comfortable with what NAV financing actually means for the fund and for them as an LP.
Thank you very much, Mike. I think indeed that you covered very, very well all regarding 2023. If I could just take 3 points from my side, because as I always say, from Luxembourg, we're quite in the center for fund finance, because we're working transaction with Asia, with the US, London, France, and so on. So indeed, we have seen a slow in terms of fundraising. So it took longer than expected to close transaction, or we were contacted for a new transaction. Then you close. Yes, you take longer to close it. And we also see an uptick in terms of NAVs, and I agree with you, Mike. So it's more NAV to inject capital in the portfolio company for follow-on investment than to distribute dividends that you have seen. And also another trend is the rating of for fund financing, and as you have with the capital requirements and so on, this is indeed a topic which is important at the time being. And as well, this is as well used for syndication purposes. But Aleksandra, for 2024, I would be also curious to have your outlook for the year, and how do you see the things?
Yeah, absolutely. I think the biggest question as we go into 2024 is whether we're going to see an improvement in market conditions and whether that will unlock exits and stimulate fundraising. So we start to see some sort of new momentum in the private equity industry. I think investors' sentiment is changing, it's improving. And, we've already alluded to it. There is a plethora of liquidity solutions available to GPs. So, as the market matures and sort of becomes more sophisticated and innovative. So, if as a GP, you feel like you cannot realize your desired multiple, you don't have to sell the asset to raise the next fund. You can tap into the secondaries market. So I would think we're going to see a lot more evolution in that space this year and probably into the future. Overall, I do think the market is positioned well for the long-term growth. Preqin predicts that global private markets are going to grow by more than 50% in the next 5 years. And why? Well, investors are chasing alpha, more alpha than you can get in the public markets. But it's not just returns, it's also the need for diversification, and of which we see less and less in the public markets. PitchBook recorded a record number of take privates in Europe last year. And generally companies tend to sort of stay private for much longer. So, that's the space where the value creation happens. So, so you've got this sort of long-term opportunity. And then, the question is, who's going to support GP's growth ambitions? We know that a lot of the traditional sources of capital, the sort of, big pension funds, insurance companies, especially in North America, they have invested in this space for decades. So naturally, they are getting tapped out for one reason or another. So, we're already seeing a lot more sovereign wealth funds becoming much bigger players in the space, but also private wealth, interestingly. And I'm not just talking about the top end of the market. Blackstone, they have targeted this space for years. So there is, that's why they start to see traction. But interestingly, we see the evolution in the mid-market space as well. So, and it's either brand new GPs raising their very first fund, attracting meaningful commitments from private wealth, but it's also established managers raising their, third, fourth fund, where after, securing re-ups from institutional capital in the previous fund, they then end up admitting private wealth with, straightforward due diligence processes before being able to admit new institutional capital, where normally it takes months and very rigorous due diligence before they can sort of commit to a brand new GP relationship. And, that's, and why am I talking about? Because I do think this is going to pose a very interesting conundrum for the fund finance industry, because as we all know, traditionally lenders in this space, the preference has been to underwrite higher quality LPs with either no advance rate or a much lower advance rate afforded to non-institutional sources of capital. And now, obviously, one must differentiate between an individual high net worth investor and established family office perhaps managing generations of wealth and operating as a quasi-institution. But I do think that sort of one way or another, more work will go into analyzing and underwriting LP commitments from those less traditional pockets of capital. So that's the one thing I wanted to mention, and I will give the floor to the others.
Thank you, Aleksandra. And you, Corinne, looking ahead, what do you see on your crystal ball?
So I think on the NAV facilities, I guess it will be interesting to see how that sort of plays out this year. If there are not exits, I think you're going to keep seeing NAV facilities as sort of a bridge loan structure. But I think if there are exits, I tend to think that, NAV facilities are a thing until they're like not a thing anymore, and that there's probably a portion of the market that is going to try to use it as some permanent financing solution, and I do think it will be a tool, but I tend to think that it will, be less important or less essential for folks to use as a liquidity option going forward. Though I do think that there's a ton of focus on it right now, and everyone is like trying to understand even what a NAV facility is and what the different flavors are. But I think there's going to be more education this year in terms of what LPs understand about them and the funds themselves, and then also more standardization, I think, from the LPA perspective, and documentation wise. So that, I guess that covers sort of the NAV front from my end. Another thing that I think will be interesting, though it's not a prediction, I hope it doesn't happen, is just, the subline market, I think, has sort of been tested, and lenders and borrowers are comfortable with what happens if there's a default. And I think, at least on my end, I have not really seen that the NAV facilities are just kind of getting done. Like, right before there were like NAV term sheets and nothing was actually happening. Now you have closed NAV deals, but like, what happens if there's defaults in this world? And I don't want to find out, so I'm going to leave it there. That's sort of the things that I'm focused on in 2024.
Thank you, Corinne. And Mike, from your side, what do you see looking ahead?
Yeah, sure. So I think I kind of touched upon it and kind of gave away my outlook for 24 in some respects, but I think that there will be a lot more focus on Basel IV from lenders. There's been varying degrees of focus from the lenders, certainly in Europe, on the topic. I think McKinsey produced a report that suggested that if the banking industry stood still and did nothing, it has about 130 billion euros of additional capital that the banks have to find. And I think looking specifically at subscription finance, generally speaking, the risk weighted on a blended basis around 60%. That moves to standardized 100%. So there will be a lot of focus from lenders, whether that be a rating, which is a zero-sum game. It gets you back to that sort of circa 65%. We spent a lot of time across the fund finance practice and the capital markets practice the second half of last year, looking at ways in which we could apply some of the securitization technology to single securitizations on sublines. And I think we will start to see those come to the market this year. I think that we were fairly well advanced in conversations on that front. So I think that will certainly start to come to the front. Whether or not that cannibalizes an element of liquidity, because not all banks can look at it on a securitized basis, but it certainly creates additional capacity, because that risk weighting, certainly for the sort of AAA, AA tranche, goes down to 15, 20%. So it's actually capital accretive. So it's not a zero-sum game. I think from the ratings perspective as well, we'll see a lot more balance sheet management, particularly with capital relief trades. And I think we've been very focused on fully funded institutional capital solutions, trying to plug a bit of that gap on the bank market on the subscription finance side, starting to see that to come through. I think the industry still grapples with the revolving nature of subscription finance, which has prevented a lot of them, but there's more solutions coming through, and we've spent the vast majority of last year looking at liquidity solutions where GPs could harness that institutional capital and more term note style structure. I think on the NAV side of things, the UK has just gone into a technical recession. What impact is that going to have on assets? I think Corinne's mentioned on defaults, restructurings. I think there was already a big focus last year. We definitely saw a switch in the primary buyout side on security or security-like structures, where you're effectively relying on a negative pledge and a charge over an account to receive distributions from any divestments. Hopefully that won't get tested, to Corinne's point, but whether or not we'll start to see security tighten back up to the fully pledged over the intermediary holdco and individual opcos come back. There still are selective transactions like that in the market, but I think Sarah touched upon it certainly with the private credit managers offering the more security-like structures. There's still a lot of focus on valuation challenges, and I don't think that's going to go away, certainly given the broader macro and geopolitical risks this year.
Thank you, Mike. And Don, from your side, what is your outlook for 2023, 2024?
Yeah, I mean, so sort of agree, and I think, you know, that there's definitely a sense that 23 would have been, you know, the lowest point in a cycle, so to speak. But, you know, without being too pessimistic, there's still a reasonable likelihood of activity being quite choppy. I think, you know, particularly against the macroeconomic geopolitical uncertainty. We've got an election year, not just in the US, but then the UK and India as well. We've just had Indonesia. So there's a lot of change, a lot of question marks over, you know, particularly from investors, you know, where to look in Asia. I think, you know, the brighter side of that is that I think Aleksandra said there's capital that still needs to be deployed. People will still have allocations towards Asia, and there's arguably a wider variety of fund financing that we've seen. So even subscription line facilities, they're a little bit more varied in the types of terms. People have been making use of multi-currency facilities, which were sort of previously dormant, but now very helpful way of avoiding the dollar rate. You know, borrow in a local currency. There's a bunch of them in Asia, and then that might be helpful in terms of managing cash flow. I think, you know, the other thing is that in terms of investor appetite for Asia, you know, it's not purely Western LPs. There's a lot of interest from the Middle East. They've got a strong, willing investor base. So potentially looking for opportunities in Asia, while others might be on the sideline. And in terms of deal structure, there's a question as to if their influence sort of dictates the type of investments and even the type of financing. So whether we see sort of more Sharia compliant types of facilities being introduced as sort of accommodation of a different type of investor base. So there's all of that. There's NAV, which, as I say, is still very much to emerge. And then, of course, private credit as an asset class, but also as a fund in Asia, which is, you know, is growing, but is still going to catch up by a long way. So I think I would say I'm more positive in terms of 2024. There's going to be a lot more interesting and a lot more variety of deals, but it's very hard to sit and make a prediction with any sort of strong degree of certainty where we'll be this time next year.
Thank you, Don. And Sarah, what is your perspective on this?
Well, like everyone, everything that was already mentioned, I think I'm not sure I'm like super optimist to be honest about 24. You know, we saw that, you know, things are just getting harder, and I think, as a few mentioned, there is a lot going on this year: recessions, elections, wars, a lot of geopolitical issues, which are all affecting the macro. you can read a lot of articles, and at the end, all the indicators are just not great. So we don't believe, and no one has a crystal ball at the end, but that is going to be an easier. Fundraising is starting very slow, and even big names are saying, it's hard. So we believe this year will be still challenging in terms of fundraising. I think an important thing is going to be the performance at the portfolio level and the valuations. We are getting a lot of clients which are getting challenged by the investors about their valuations, who are getting very stressed that the valuation might not be right. So there will be a lot of pressure around that. And recessions mean we will see some assets with an increased number of assets underperforming. So there is definitely a lot happening at the portfolio level, and that will be happening. We've seen that already in the real estate market, where valuation dropped drastically over the last few months. Everyone, when we say we look for real estate, get really shocked just because of where the market is. I think we will see that across other asset classes also. More stress around the portfolio. So that means, yes, financing will be challenging in the way, not because there is no, supply from lenders, but just because people are going to be more diligent on which financing, which opportunities, which asset classes. At the end of the day, the capital call facilities are looking at investors. I think it will remain challenging just to find the right appetite depending on the ancillary and the size. But the risk, I think, would be very different than the NAV facilities, which, depending also on the asset class, have very different risk profile. And I think what some, lenders who are not investment banks and maybe not as used to look at the asset risk and have done facilities, if there was something going wrong, it might be challenging for them to really get grasp around that. So I think there will be definitely an increased due diligence from lenders. And we saw that over the last few months, to be honest. Every transaction we have been doing is difficult. It's just, even for a capital call, everything is just really difficult to put in place. We don't think, everyone has the hope that base rates are going to go down, but we don't believe pricing, margins and other fees will go down, to be honest. We don't believe that will happen in 2024. And we get asked all the time by some clients, should we wait? Maybe pricing will come down. We're like, well, not in 2024. We don't think so. And I don't know if it will come down at some point, to be honest. We all hope one day, but it's not happening in the next 12, 18 months. So that means people have to think differently about their financing strategy. Sometimes we speak with clients and we're like, you need to think, what is the purpose you're trying to, achieve here in terms of putting lending in place? And is it going to worth, all the execution, the risks, the due diligence, the intense process, and all the cost that comes with it? And to be honest, at the moment, because of where the all-in cost is, a lot of clients decide to not put facilities in place, and sometimes even for capital call facilities, or put a lot smaller facilities, just because it's very expensive and it's becoming increasingly difficult. So unfortunately not an easy year. And the perspective, I think, as few people touched, we really believe there will be more and more non-bank lenders coming to the market, notably on the NAV space. And I think that will shift the market in a different way in terms of sophistication, structuring. I'm not as worried about, default on that side. And maybe, I don't know, because I come from an asset background, but I think, you have recourse to a portfolio. Usually LTVs are quite low, and they are diversified, asset in terms of asset classes, geographies. We've never done an extremely aggressive transaction. So I think there is plenty of buffer there and triggers to really get around that in terms of control. And at the end of the day, you have a tangible asset. I don't know if I have to go after an LP based in, UAE, how I will get really my cash back. I would prefer to have the asset personally, but so I think, and also, these non-bank lenders who are coming to the market, they are doing asset financing. That's their bread and butter, right? These guys know the market really well. So I think they come with a very different expertise than some of the commercial banks who have been doing occasional NAV financing. And I think that will be like a market that will evolve and become more and more structured with time. So I'm quite keen to see that evolution. And to be fair, since I've joined this market, I mean, changed a lot. It keeps evolving and becoming more structured. So I think these difficult times will push that, in a quicker way.
Thank you, Sarah. And Don, I will be curious to know what is the setup of a typical fund finance transaction in Asia.
Yeah, so fund financings, I mean, if we're talking about capital call facilities in particular, they're not really dissimilar to the sort of typical structure that you would see in other jurisdictions where the product is popular. So the US and Europe, that you would recognize a subscription financing if you saw one in Asia. In terms of fund domicile, Cayman is by far the most popular jurisdiction to establish a fund, certainly from a standing position, and then inevitably this can vary depending on particular fund's investor base or needs. So we see Luxembourg parallel structures sort of relatively frequently. We also see some regional focus. So Singapore established funds often again as a parallel structure. And then more recently, since Hong Kong introduced its own limited partnership fund legislation, some investors choosing to use that as a sort of feeder vehicle, or even an outright fund using that regime. Documentation-wise, often dictated by the size of the facility, and so by that I mean you sort of see two tiers of documentation. You have the typical club lending documentation, which is based on market standards, so LMA or LSTA. So that is sort of very, very sort of similar style of agreement. And then with maybe smaller facilities or smaller banks, or banks who even just focus on this as a particular product and type of documentation, which is typically quite a bit more restrictive, but the benefit is it's much quicker to execute. It's much more of a sort of fast and easy product to set up, particularly for a new fund.
What's the governing law? Sorry.
Yeah, so essentially governing law will, I would say the main jurisdictions where you would do capital call financing is Singapore, Hong Kong. Governing law can be Hong Kong or Singapore, and then also we see English governing law for the facility agreement. The collateral package is, basically identical as far as I can see it. So an assignment over capital call rights, and then an account security agreement. And the assignment, I mean, the governing law of that can be match the facility. So Singapore, Hong Kong are all common law jurisdictions that are very similar to English law. Or some lenders will choose Cayman Islands just because the fund documentation is governed by Cayman Islands if it's established there. So I would say, it's not unusual for facilities to be tranched into uncommitted and committed portions, and that's a cost-saving measure. Even potentially fully uncommitted facilities where it's a strong relationship with the lender, and there's sort of limited concern on the fund. And beyond that, I would say, relatively similar features that you would see in any other sort of syndicated or large financing for certainly larger regional funds that you would see in the market. I think DD, again, very similar. Banks are pretty granular in their DD, so they will go over the entire LP base very carefully, and that doesn't really vary between banks, even those who are sort of very familiar with the product. Maybe slightly more old-fashioned. Some funds still have physical data rooms where they're very careful about confidentiality, so people all have to troop in. And sort of on the flip side, lenders are often quite conservative in their perfection requirements for security. So you will see hard copy notices being delivered to LPs, and even the requirement for acknowledgements in some cases. So quite a little bit, or I would say a little bit more conservative than you might see in other markets, where it's sort of electronic notices or even just a notice with a next quarterly statement. I think to couch all of that, liquidity among banks in Asia is still quite high. So there's still a relatively strong appetite for lending, which adds to it being a relatively competitive market. So we have the large international lenders. We also have regional banks who are very keen to be involved with fund financing as a product generally, not least because it opens up clients to a sort of spectrum of other products that banks can offer them. I think I mentioned earlier in the outlook for 24, where we're seeing non-bank lenders coming into the market, how this will allow the different players to differentiate themselves. Pricing in Asia is generally lower than the US and Europe, typically around 50 to 100 points under what you would see for an equivalent fund. So it's really about product expertise, the ability to vary the type of offering to accommodate any kind of needs that a fund may have, which may end up being a sort of separating effect between different types of lenders. So I think that's hopefully a 101 for Asia fund financing, but happy to tell people more.
Thanks very much, Dan. And Sarah, in terms of funds domicile, what do you see the most? What have you seen the most last year?
Well, because we do multi-geographies, I would say there is a big dominance usually about Lux. So in the US, we see a lot of Delaware, Cayman. So those are the two main ones we see. Lux for a lot of the UK and European funds. And then when we do I would say managers in France, for example, or in Italy, under a certain size, they tend to still be kind of like French domiciled or Italian domiciled, for example. The challenge they get actually is when they reach quite a big size and they need big facilities, and there is not enough appetite from the regional lenders, and they want to open up to more like global lenders. Those guys can't necessarily lend in those countries. And then we have been kind of having conversations that actually moving to Lux will be a lot easier. But yeah, I would say in Europe, it's mostly Luxembourg.
Thank you, Sarah. And Mike, from your side, what do you see?
Yeah, similar to Sarah, to be honest. I mean, a lot of the transactions that I look at, certainly out of Europe, the vast majority have been Lux-based. I mean, we see all jurisdictions, but Lux has definitely been the most prominent. I did do a straw poll with the legal practice before here, and their views were similar. So across the sort of circa 20 attorneys, they all suggested that Lux was the dominant jurisdiction that they see. I think it's helpful for a number of reasons, but we actually looked at a fairly unique structure last year where you essentially had an umbrella structure under Lux law, which I'm sure you can tell people more about it than I can, Michael, is you can segregate assets and liabilities under local law without physically creating SPVs. So we created an umbrella structure where each compartment would roll out new strategies without creating physical SPVs, and so you'd segregate the assets and liabilities. It wasn't straightforward. Obviously, from a commercial perspective, the concept is fairly simple, but when you actually come to documenting that type of structure, it's not as straightforward as perhaps you'd expect, but definitely Lux.
Mm-hmm. Yes, actually, regarding Lux, one of the main advantages is really the security package, because generally when you structure your security package for fund finance, these are financial collateral and they are bankruptcy remote. So you have a quite efficient and robust security package, and as well the palette of type of funds that you may have in Luxembourg, like this umbrella structure, when indeed each compartment is really segregated, so it's protected from the creditors of the other compartment. So These are actually the main advantages from Luxembourg. And Corinne, from the US, do you see the same in terms of fund domicile? What do you see?
Yeah, it usually Cayman or Delaware on our end, and then sometimes Lux, and also sometimes I think Irish ICAPs I've been seeing more often lately.
Mm-hmm. And Alex, from your side?
Yeah, I mean, we don't really get to see Cayman that much. Luxembourg is definitely a winner. Although we do see a sort of a reasonable spread across some of the other jurisdictions, Channel Islands, Ireland, UK. But yeah, Luxembourg tends to dominate. And yeah.
Okay. Yeah, another topic actually is ESG and Fund Finance. So from my perspective, in 2021, 2022, we have seen many of those type of transactions and an increase of those type of transactions, but less in 2023, maybe for obvious reasons, regarding all the market manager refocusing on the basics. So yes, I would be interesting, Aleksandra, to also have your perspective on this. So have you seen many of these transactions in 2023, and what do you think for 2024 for these type of transactions?
Yeah, absolutely. I mean, ESG is such a fascinating topic. I wrote about it for you. I spoke about it at the FFA. As I look back, I think it's been quite an evolution since the early adoption in the fund finance space a few years ago. And really two things I wanted to mention here. So first of all, ESG facilities, they are being done, but it's not exactly the sort of mainstream trend, which some of us may have expected 18, 24 months ago. And I think there are a couple of reasons for that. So on one hand, it's the length of time, the level of complexity, and frankly, the cost associated with negotiating all of the ESG elements. It takes good few months for the borrower and the lenders to agree on a set of KPIs, and the other elements that go with it. And, you can only imagine the level of effort over that period of time. Nowadays, the majority of lenders will deploy teams of ESG specialists. They also need internal approvals to hedge against the very real risk of greenwashing. And then, if you have a club with several lenders in it, then you have to multiply it by the number of lenders, because each and every one will go through their internal process. So, as a compromise, especially if as a manager you're in a rush to put a facility in place, we have seen facilities being executed with the ESG link sort of being considered on the assumption that all the relevant terms will be agreed and incorporated at a later date. But to be honest with you, many of these facilities never evolve into ESG linked facilities. But then if they do, then, there is the additional reporting. There is the need for external independent verification of data. And yet again, the cost associated with all of it. So I think it's no surprise to see sponsors perhaps think twice before they embark on this journey, with the cost benefit analysis very much at the forefront of their minds. And there's definitely a difference in approach between the sort of lower mid-market and the upper mid-market. So, those larger, more established managers with more resources in terms of available spend and in-house ESG capabilities, they tend to be more keen than the others, right? But, the other thing I wanted to mention here is that, having said all of that, I do believe that ESG remains a huge topic for the industry. Here at HSBC Innovation Banking, we are at the very front of innovation, and we work with a number of impact funds, from climate transition, decarbonization, sustainable food, urban sustainability. I mean, you name it, right? The very investment objective of those funds is to make a difference, to generate a social or environmental impact. So, it is happening. ESG is happening. It's just that it doesn't seem to, it's not always linked to financing at the fund level. And it's probably for the reasons I've just mentioned.
Thank you, Aleksandra. And Mike, what is your perspective on this?
Yeah, similar to Aleksandra, to be completely honest, we definitely saw a drop off in ESG, and I think it's for two reasons. The first is there's definitely a focus on liquidity and getting that money in the door on subscription finance. The other element is we saw a drop off in ESG because there was actually an overall drop off in loan issuance. So it wasn't a case, and there's probably a correlation to that as well. We actually have an ESG practice that focuses on all things ESG. So Sukhveer Bazran actually sits on the ESG committee for the LMA, and I think there's added layers of complexity now. I think when it first came to the market, banks were doing it off the side of the desk. It wasn't getting necessarily as much scrutiny. Then greenwashing started to get discussed and debated. So I think there's a lot more rigor around putting in ESG linked or sustainability linked loans now, which makes the process a bit more cumbersome. And when you do that alongside, and when you compare that alongside an environment where it's actually quite hard to get a deal done anyway, I think it's been kicked down the road a little bit. But I don't think the focus from GPs has moved away. Sukhveer spends a lot of time advising GPs on setting policies at fund level. And so there is certainly a focus at fund level and at GP level around ESG. It just might not be flowing all the way through to the lending side of things. Will that pick up this year? I think that we've all given our outlook for 2024. I don't think the lending environment is going to improve anytime soon. So whether or not that actually comes to the front, I don't know. And we talked about fundraising, new fundraising, and whether or not that's going to accelerate this year. It may come with new fundraising, that is an increased focus, or investors make commitments contingent on some sort of ESG linkage on any fund finance related transaction that they put in place. Interestingly, we haven't seen the debate around ESG in any of the NAV trades. Obviously that's a bit more difficult, but you can certainly implement KPIs. You probably arguably got more influence, certainly for private equity funds, to incorporate those sort of KPIs. But there's a different level of focus on that. I think given the institutional base, I'm surprised it's not had more pressure from some of the sort of credit platforms to start thinking about that. So I think it'll be a mixed approach again this year, similar to 2023.
Thank you, Mike. And Corinne from the US, what is your perspective for ESG?
I mean, nothing really to add. That all aligns sort of with what I'm seeing too, which was not really ESG linked credit facilities in 2023. And even, as has been said, the amount of resources and sort of bureaucracy even behind the ESG process, I think, has turned even large sponsors who maybe even have the resources off from the additional cost of doing it, at least right now. So, but that said, yes, totally agree with the point that's been made about, there are climate funds and ESG focused funds, and that there is still a focus on it. It's just not coming through the financing docs right now.
Thank you very much, Corinne. I will take a last question from the audience for you, Sarah. So do you see hybrid products as well, and do you think that there will be more of them in 2024?
So we have a lot of talks with our clients regarding hybrid facilities. And I would say they only work in certain circumstances. I mean, in the past, they rarely made sense in terms of economics because capital call facilities were so cheap, that you are better off doing 2 different lines. Today it's a bit different. So if we are looking at a very complex NAV financing, which is coming before the end of the investment period and there is still some undrawn commitments, we'll try in some cases to put a hybrid facility. And the idea is not necessarily really to drive the economics. I mean, it's always welcome, but it's more about getting the right traction with lenders. Otherwise, it might be a challenging transaction to do just looking at the NAV. And we have considered few hybrid facilities, for example, on the infra space, again, on the real estate, where, like there was not cash flow yet generated, for example, at the portfolio level. There were like some reasons why we want to put a hybrid facility. Also, it can be for managers where, it's some of their first financing at the portfolio level, and it's a small size, or maybe for some reasons, they're not going to be as attractive as like the tier 1. And it's a little bit easier to get the right solution through hybrids. But that said, we'll say there are not that many hybrid. We have a lot of conversation, but they are quite complex to put in place. And hybrid means so many things, right? It can be hybrid covenant, hybrid security, facility with 2 tranches. I mean, it like literally includes so many different options that we will only really put them in place when there is a real need for them. And that's the only way around, really.
Thank you very much, Laura. So thank you to all the panelists for your time today and our great insights. And thank you as well to the audience for your time today. And stay tuned to our LinkedIn page for the next Fund Finance series. Bye. Cheers. Thank you.
Thank you.
Bye.